This is the Definitely Uncertain podcast, brought to you by Goldrock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. Welcome, everybody, to this episode of the Definitely Uncertain podcast. My name is Darren Rockman, and I'm a partner at Goldrock Capital, the 20-year-old multifamily office servicing high net worth families in Israel and around the world. And I am very excited and pleased to have on the show someone who is both a friend and a mentor of mine as well, Marc Singer. Marc, welcome to Definitely Uncertain.
Thank you. Pleasure to be here, Darren.
It's great. Marc was the founder of Singer Zinos, of a Miami-based asset management firm for decades, looking after families in the United States, a multi-billion-dollar firm. And I actually asked Marc to join the show today because of what we're seeing going on in financial markets and particularly within stock markets, and the sense that maybe there's out there that we are moving or have moved into bubble territory on equities. So, Marc, this is what we want to talk about today. So, you've been doing this for a very long time, and if you look back on your career as an investor, what do you see as some of those the telltale signs of a stock market bubble?
Well, we've seen a lot of bubbles over the last 30 to 40 years. And the one thing about bubbles is they're always easy to spot with hindsight. The best definition I've heard, I think, is when Alan Greenspan said irrational exuberance. It was a great expression because it really does describe the essence of when you're in a bubble and you see that it's what's going on. In simple terms, it means if things seem too good to be true, absolutely they are. We have absurd valuations sometimes. You have market momentum that's out of sync with what's going on with economic growth. Why it's called a balloon is, as we know, with a balloon, the bigger you inflate it, the easier it is for just a pin to pop it, and the more explosive it is when it does pop. So those are what make up a bubble. We could talk a little bit more about some of the examples over the last 20, 30 years. I guess at the beginning of my career was the Japanese real estate bubble, where in Japan they were bidding up real estate 600-700% in terms of their real estate holdings. It so affected them that it took them nearly 20 years until about 2000, 2003, till their economy even began to recover. They destroyed their own economy with that bubble. We all remember the S&P 500 starting in 2000. In 2009, it was down 57% in a 9-year period. It took another 4 years just for it to break even. So it's called the lost decade, but it's really the lost 13 years. The S&P earned zero for that period of time. We also remember .com, what it did to NASDAQ and things like that, which was even worse than the S&P. So the real question of bubbles is, why don't people see it when they're in the middle of it? Everybody knew about .com. No, I remember .com, and everybody believed something was different. It's different this time.
Right. So, irrational exuberance. What are the telltale signs of irrationality? How do we know? Look at the market today. We're having amazing top line growth. We're having amazing profit growth for a lot of very large companies. So is the market pricing irrationally, or is the market pricing rationally?
So, good question. What we see happening is parts of the market are irrational. We'll get into other examples of what's just craziness going on. But the fact that earnings are growing, when earnings are growing, multiples can grow. They just, we like PE ratios because it tells us a very quantitative amount of when we start getting out of bounds. So again, going back historically, the S&P 500 in the 70s and 80s was 10 times earnings. By today's standards, really, really cheap. But again, we remember that, and it was considered, well, the stock market's not such a good place, and that's why it was priced so low. People were really sour on the stock market. And then it went up in the dot-com era, it went up to 24, 25 times earnings. Oh, that's really expensive.
Yeah.
The average is about 19 times earnings. Take all the plus and minus. Well, we're somewhere between 35 and 43, whether we're looking in backward looking or forward looking. So that's the range. It's high.
Yeah.
The level of the market. And we have to be concerned about that. That's not the same thing as we know we're in a bubble, but we're getting closer and closer to the we could be. And the question is, what's the catalyst, the pin that pops the bubble? In 2008, it was obviously subprime debt, and subprime debt sucked all the liquidity out of the market. We couldn't even trade a AAA bond, wouldn't trade. Well, that just had a really traumatic impact, and we came close to a total economic collapse as a result if the regulators had not come in with massive amounts of stimulus money.
So let's just focus in on the comment you made before, which is whether it's different this time, because that's always the argument. It was the argument back in 2000. I remember it. I am old enough. Technology was just the new thing, and communications valuations were considered to be different, or should be treated differently to the valuations of regular operating businesses. But we're now in an age which is the most marked by the fact that we're in ultra low interest rates, and ultra low interest rates, not only low, but low for long. And we don't really see at the moment very few indications of interest rates going up. And of course, low interest rates mean people don't make money depositing in the bank, don't make money buying bonds. Is that really different this time?
It's temporarily different. I'll quote biblical scripture. There's a quote that says, "There's nothing new under the sun." And that was written over 1,500 years ago. And the fact is, it's true. Yes, we have technology, and the speed of which things move is incredible. But factors like human greed, human fear in the markets, those have not changed, whether you were trading tulips in Holland or you're trading Bitcoin today. Gravity is gravity. If something goes up too high, it's going to come back down. So interest rates is interesting. Why are interest rates so low? Because they're being artificially suppressed by stimulus money coming from the central banks. They need it because it's one of the only tools that they have to get things going again. So on what they look at it, it's cheap money for people who borrow on credit. But on the other hand, it's very discouraging to savers, where a bank pays 0%, and if you have a really good rate, maybe 0.5%.
And if you're not in the United States, negative.
And it can be negative, right? In Germany and other places, which is a few years ago, that was incomprehensible. What does a negative interest rate even mean? They pay you to borrow money, I guess. So now we look at the other side. What's really going on? The U.S. has $5 trillion in the last 12 months in stimulus money. Well, everybody. And I have clients, and they're saying they're simultaneously concerned about the deflation of the dollar and superinflation, but how do I get in on Bitcoin?
Right.
And they're looking at both. It's like you got to worry about one or the other, but you can't worry about two things at the same time. Right. So the stimulus, it's just economics, will lead to inflationary pressure. when the economy starts to have momentum, which should be this year if COVID gets under control, and then we're going to start seeing inflation. First, we'll get to what's called a healthy inflation rate, 2.5%. And then for a period of time, we may see a higher inflation rate. And a bank can't pay 0% in a 4 or 5% inflationary environment.
So I think that's probably the key point, which is at what juncture does the market turn around and say, now inflation is kicking in, now I need to be worried about valuations? Because, if interest rates were sitting at 3%, I think arguably you wouldn't see the current valuations you have in the market because people would switch out of equities and go into lower risk bonds. That's not happening now because you can't earn any money in bonds, or very little. At what point does the market turn around and say, hold on, I don't want to be in equities anymore, and that is the needle that pops your balloon?
Balloon,
but the balloon.
No, I don't see it happening because of the huge disparity in returns. 1 or 2% bond versus 10, 12, 15% on equities. For people to jump from equities to bonds, and traditionally, if an equity is paying 7% and a bond's paying 4%, and then there's perceived excessive risk in equities, people will shift over. Yes, I'll take 3% less, but I have a lot more safety. The disparity is so great; it's going to be quite a while before people jump to bonds. So people in a bursting bubble or panic selling, they'll jump from equities to cash.
Right. Which has the same effect, actually.
It has the same effect, but it's different than them shifting. That's not an investment strategy. That's panicking out of the market.
Yeah.
Fear.
Right.
And so we just don't see that happening. The economy should be solid. The actual numbers in the economy are pretty good for 2021. And as long as we proceed on this plan, we should have some economic growth, some economic recovery this year, and have a decent year. I don't think the S&P is about to burst, but there could be a catalyst that causes that.
So when we talk about catalysts and exuberance, I don't think we can avoid what everybody knows now as the Robin Hood phenomena. We talked about it on the podcast probably 5-6 months ago. It hit the papers around the whole GameStop thing, now in silver. What does that say? I don't want to focus in on the specifics of what happened on those in that particular stock or those stocks, but what does it say about the state of market psychology? Is it just that we've got a whole new group of investors who are in the market and doing what they're doing, or does it indicate that there is some fundamental rot that is going on within the market?
I think it's the first thing you said. I think we have a new generation of investors, highly tech savvy, the millennials, can operate their entire financial life on a cell phone with one hand.
The other one needs pasta.
Right. And Robinhood is an offshoot of that phenomenon. The positive, they're giving accessibility. With $1,000, $2,000, you can already be trading. The problem is with $1,000 or $2,000, you can leverage it and end up $100,000 in debt.
And Robinhood encourages you to leverage it by encouraging you to use option strategies.
I would say that maybe past tense. In the very near future, that will be past.
Right.
They've obviously attracted so much regulatory pressure. And there's liability. There was unfortunately a suicide related to an over leverage on an account.
Yeah.
They're going to have a lot of concerns about it. So their technology, it's disruptive, but it's not I look at it back in the 70s when Schwab and other places went to discount brokerage, because there was never discount brokerage. Right. Oh, this is going to change the whole landscape. No, it actually made it much more efficient, and to the point where we've evolved to $5 trades to free trades,
right?
Which was unthinkable 20 years ago.
So with a bit of perspective, this is not the first time that new forms of business and new technologies have attracted new people into the market.
Right. And I guess using the GameStop, since we've apparently come almost full cycle in a whole 7 to 10 days, the hundreds of thousands, possibly millions of people who had been playing with it over the last week or two, anybody learning a lesson? I mean, they might have had $500,000 and now they have, $50,000 of it left. And I always use the example. I do this with my kids. If somebody, let's take an example of they were playing GameStop and they started with $10,000, and through the use of leverage, they got it up to $500,000. And then all of a sudden it fell, and now it's worth $30,000. Did they make money or lose money? And they think about it and say, well, they made money. They went from 10,000 and it's worth 30,000. They did okay. And in the real world, absolutely not. Every one of those investors will say, I lost $470,000 because it was worth 500 and now it's worth 30,000.
Right.
And that's the psychology.
It's interesting because, if we take this back to 2009, I remember being in a taxi in London where the taxi driver told me that he'd owned 3 houses in the UK. And he was still driving his taxi through the whole time, but with endless leverage, 100% plus, he could buy himself 3 houses, and he flipped them a couple of times. And then, of course, they weren't worth anything. So, and I remember him saying to me, I'll never do that again. So does this happen now? Does the Robinhood investor now run away?
Most of them. Yeah, they're now experienced. They were inexperienced before, now they're experienced. So a few of them made a lot of money on it. A certain percentage got out at that $400 range and made a killing. Who knows if the whole thing was a manipulation by a small group of people on the Reddit site? We just don't know yet. The SEC investigation may turn up some interesting data on that. But the vast majority of them ended up losing what they thought they had.
Right.
And so the next time, you can only keep doing that so many times, and then you're an experienced investor.
That's right. Then you know what you're doing.
we always felt somebody in our firm that had never experienced 2000 and never experienced 2008 and had never seen the fear and the destitution when people went through that. They weren't yet experienced. They were still green. You have to understand, especially when it's other people's money and you see the emotional impact that losing money has on people.
Sure. Unless the person has been through one of those cycles where you ask him how work was and he says, my family's terrific, then he's never been through a stock market meltdown.
Correct.
So now let's sort of move to the sort of practical aspect. We are, whether we're in a bubble or not, we're certainly at stretch multiples, as you mentioned before. What's an investor to do?
So we always like to take the medium road. And if multiples are too high, and maybe we're heading towards a bubble, but we're not sure, then take some money off the table. Change your asset allocation. If you were 70% equities, move it to 60 or 55% equities. If you're wrong and the market keeps going up, great. You still have 55% of your money in equities and you're benefiting. And if it really, the bubble bursts, you're really happy you took some money off the table, and you keep taking it off the table. I mean, it's not rocket science. It's just called rebalancing. And don't let the greed get a hold of you. I don't need to rebalance because this time it's different. It's just going to keep going up. It's never going to go down. And as long as you have some discipline of saying, I understand there's risk, I'm willing to take some risk, but I don't want to be overly risky, and it's based on your financial situation, your age, where you are in life, then just pull some risk off the table. But it's never all or nothing.
Right. And what about sectors or geographies? Are there things that you guys are looking at that you think are more attractive or less attractive today?
We always We always like whatever is the best value. So we've been shifting from growth to value, but a modest shift because value has been undervalued for the last number of years. Growth has sucked all the oxygen. We like small cap over large cap. You have to be careful with small cap. It's obviously much more volatile, but the returns in the last 3-4 months have started to really outperform large cap.
Yeah.
And we like emerging markets. It got really beat up, but emerging markets, if the world economy starts to recover, those will recover very quickly and have outstanding years. But again, being very cautious not to over-allocate in a sector like that.
Okay. And going back to sort of full circle to the beginning of our conversation, are there specific gauges, economic or market gauges, that you'll be watching throughout 2021 as an indicator that that pin is coming a little bit too close to the balloon or to the bubble? I like to call them bubbles. You like to call them balloons. I think we're talking about the same thing.
Exactly the same. The first thing we're looking at, because it's imminent, is the Biden tax plan. Probably won't come into effect in 2021, but they'll start talking about it once you get some more people vaccinated. And of course, the COVID vaccine progress, the variants, is it going to work? Is it not going to work? If it can start getting, it doesn't need to be cured, but as long as there's this hope that this is a curable problem, then we have to get past that. The stimulus, okay, we have $5 trillion of stimulus, including the stimulus right now. Is there another one? Is there another one after that? There's a point where you just keep digging the hole deep enough. It's very hard to get out of. And then the normal things you look at: weakening dollar and credit spreads, commodity prices. How are those moving? Is it showing that there's tremendous uncertainty supporting future equity prices?
Okay. All right. Great. Well, Marc, that was really terrific and enlightening, and I really appreciate you joining the show today. Thank you so much.
My pleasure. Wonderful to see you, Darren.
It's wonderful to see you too. Thanks everybody for listening. Check out more episodes on YouTube or wherever you get your podcasts. If you have ideas for episodes, please do let us know. Thank you to our producer, Andrea Herman, and to our editor, Idor Schlesinger. I'm Darren Rockman, and we'll see you next time.